Hello everyone, Giridhar here. This is my first session. Today we are going to see Banking and Financial Awareness Lecture 1. So this video is going to be useful for those who are preparing job interviews in financial institutions like banks and insurance, and definitely going to understand the basics for those aspirants who are studying current affairs or financial economic news daily to clear the exams. Okay, so we will go to the session first. My theory is you have to start from the scratch. Okay, so as you can see this questionnaire, what is bank? So from this basics I am going to take and go up in the ladder to the advanced ones. So always starts from scratch and go to the advanced ones, so you will have the better clarity than others. Okay, so the this is the first question you may encounter in your interviews or in any sort of questions they can ask is what is bank. First question. So bank is a financial institutions which accepts deposit for the purpose of lending. Okay, as the definition implies, it accepts deposits from one customer, and they lend those money to the other customer for the higher interest rate. Okay, so those interest rates will come as a profit for the banks for their operational expenses. Okay, this is how the banks work. There may be a number of definitions around the world for what is bank. This can be the best definition you can give because there won't be any cross questions if you answer this one. You may note it down, those points which you are seeing in the screen. It will be really helpful for you. Okay, the next thing is how banks generate profits. Okay, the first one is interest income. Okay, NIM, which means net interest margin. Okay, it will be a separate chapter. I deal it in the next slide. So that will be the main profit channel for the banks. Based on the interest income only, they are generating more profits. Okay, so everyone will say those answers, but we should be our answer should be unique from others, so the interviewer or those who are hearing our answers won't get bored. So the next sort of answers which are very trivial, but it adds more value to your answers. Okay, service charges means whatever charges you are getting paid to the banks. Okay, for any transaction charges nowadays, minimum balance fees are also getting debited. ATM card fees for a quarter or yearly or half yearly, they are getting debited. Locker fees for safeguarding our jewels or any other valuable things. Then interchange fees means suppose you are having a bank debit card from one bank, but you are using that debit card to debit amount from the next bank. Other bank means there will be interchange fees paid, which will be paid by your bank to that bank. So those are also comes under the profit. And the stocks, banks can raise money in stock exchange by selling their some stocks share values. And then the fourth last and but not the least one, exam fees from the aspirants. Nowadays around 850 to 1000 rupees per candidate. Okay, so that also comes as a one more profit channel, I would say. So these things you can note it down. So these are all the things banks generating profit. The majority of the channels, they are generating profit. Okay, next thing is net interest margin. Okay, this is the one criteria parameter which defines whether the bank is healthy enough or not, whether it will go bankrupt or not. Okay, let's see. In net interest margin, we have two branches. One is cost of funds, and the other one is yield. Yield, yield, yield income. Okay. First, we will see the cost of funds. Cost of funds means, in other terms, we can define it as a liabilities for the bank. For example, if a person having a savings account with a bank. Okay. So the bank will safeguard the savings account money on behalf of the customer, and the bank will pay some part of amount as an interest to the customer. Okay, so those deposits are comes under cost of funds because it costs something to the bank. The bank should pay some interest to their customers. Okay, there can be two deposits. One is demand deposits and the next one is time deposits. Demand deposit, as the name implies, that on demand it will it will evaporate. For example, if a person, Mr. X, having a 10 lakhs rupees in his savings account, next day he is, due to some urgency emergencies, he withdraw all the money 10 lakhs from his account, which means on demand he is demanding his money from his account. So on demand it can be withdrawn. Time deposit means there will be some lock-in period. Before that the customer cannot take that money from their bank, which means time deposit. Okay, so those things also customers can take their money from the banks, but there will be some penalizing, some penal charges like 1% of the, it depends on banks to banks. There will be some penalty to pre-withdrawal from their time period. Okay, so these two things, demand deposits and time deposits, will be the cost of funds for their banks, or assets, sorry, liabilities for the bank. And the next one is yield or income. This is the asset for the bank. Okay, here bank is from one customer already taken all the deposits. Okay, like savings account, current account, fixed deposit, bulk deposit, those things bank already collected some money and stored as a reserve. Now bank has more money value. So bank is now going to disperse it as a loans and advances. Okay, it can be a housing loan, vehicle loan, personal loan, or mortgage loan, agri loan, anything. Okay, so for this dispersing of loans, the customer here will pay the interest amount to the banks. Correct? Okay, that interest, average interest rate, will become the yield. In cost of funds, bank will pay the interest to you, and in yield you will pay the interest to the banks. Okay, now net interest margin is nothing but yield minus cost of funds. Okay, that is the basic formula for the net interest margin, which means suppose a bank is having a 5 lakhs rupees as cost of funds. Okay, now bank is lending at a higher interest rate. Suppose 5 lakh rupees, 3 percentage bank is giving as a cost of fund, but for 8 percentage the same 5 lakh rupees is giving as a loan to the another customer. So 8 minus 3, 8 percentage minus 3 percentage is equal to 5 percentage. 5 percentage is the net interest margin for the bank. Okay, the next thing is, this is the sample data which I have taken from the official site of one famous public sector bank. You can see the net interest margin in their site. For financial year 2022 to 2024, they have posted it's always above 3 percentage, which then what we can conclude from this is, as per the guidelines, not the strict guidelines from the RBI, some valid suggestions from the RBI side is always maintain your net interest margin above 3 percentage. Okay, then only the bank will be healthy enough to run their business. Okay, what will happen if it comes down near below the 3 percentage? So it won't have the enough money to run their business, and it may bankrupt one day. So to avoid those things, there is separate channel, separate what do you say, conduct complaints called PCA, prompt corrective action. We will see it in the later session, those things in detail. Okay, first, we will complete these things: cost of funds, yield, and net interest margin. Now, you may have one rough idea about these things. If someone asks, you can say it like this. Okay, and as I have said, RBI is advising us to always maintain above 3 percentage net interest margin. As a banker or as a financial institution worker, how do you achieve this percentage, 3 percentage? Let's go back to the same slide here. Okay, in the demand deposits, as I said, savings account and current account, I have highlighted the current account. Why? Means current account having 0 percentage of interest, which means if a person is having a current account with the bank won't pay any interest to the customer, because current account is only for the shopkeepers or merchants who are doing daily n number of transactions. There will be n number of transactions in current account, so there won't be any interest rate to be paid by the bank. So whatever amount is available in the current account, it will be beneficial for the bank because there is no interest going to be paid. Even for savings account also, it is up to okay up to some level, because in savings account you can take any bank. The maximum rate of interest bank is giving to the customer is 3 percentage or maximum 3.5 percentage in any banks in India savings accounts. Okay, so those two things are the main criteria for the banks to improve their NIM, net interest margin. Okay, especially the current account, because 0 percentage interest. So next one is time deposits. Okay, so in demand deposits, if the demand deposits is more, which means the fund value in the demand deposits is more, means the bank will have higher liquidity at any time. Okay, but it cannot plan for a long term investment with those amounts, because right now today it may have more funds, but based on demand the customer may swipe out all the funds from his account. So there won't be any credibility, I mean there won't be any surety the amount will be tomorrow present tomorrow. So it will always bank have to balance between demand deposits and time deposits, because if but in time deposits if the fund amount is more, there will be a lock-in period like 1 year, 5 year, 10 year. Okay, so for those period, with those amount bank can plan for their long-term investment. With those long-term investment they can earn more profit based on their investment. Okay, so the bank always try to maintain their demand deposits and time deposits, okay, at a similar manner. Okay, and the next one is, sorry, yes, if you found it is useful this video, you can comment down the next topic which I need to take, and feel free to comment if anything interesting.